The United States federal government collected its first permanent income tax in 1913. That is the standard account, and it is accurate as far as it goes. What it does not account for is the 40 years of institutional architecture that made 1913 not a beginning, but a conclusion. The moment a specific financial arrangement, built by a small number of named banking houses and treasury officials, finally closed around the American state and locked into place. The question historians rarely ask is not when the income tax arrived. The question is what funded the federal government before it did, who collected on that arrangement, and why the men who profited most from the old system were among the most vocal architects of the new one. If you're enjoying this story so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. The standard account presents the income tax as a democratic reform, a triumph of progressive politics over entrenched wealth. The financial record presents something more layered and considerably less comfortable. To understand what the ledger actually shows, the account has to be opened at the tariff, which is where the American federal government's money came from for most of the 19th century, and where the institutional interests that would eventually replace it were first built. For most of American history before 1913, the federal government ran on customs duties. Tariffs on imported goods were not a supplementary revenue mechanism. They were the financial skeleton of the American state. In the decades following the Civil War, tariff revenue accounted for roughly half of all federal income, often more. In the 1880s and 1890s, the federal government routinely collected more in customs duties than it spent, generating surpluses that became a political problem in their own right. The Treasury did not know what to do with the money. Legislators debated reducing the tariff simply to stop the accumulation. This was not a government that lived paycheck to paycheck. It was a government that, for a specific historical window, was financially comfortable, and that comfort rested entirely on a tax that was paid not by income earners, but by consumers. Every time an American purchased an imported good, a portion of the price went to the federal government. The mechanism was invisible in the sense that it required no filing, no declaration, no annual reckoning with the state. The tax was embedded in the price of the goods and collected at the port by customs officers before the merchandise ever reached the shelf. There were no income tax returns. There was no Internal Revenue Service as a permanent institution. There was only the port, the customs officer, and the schedule of rates that Congress had set. The tariff was also, by design, a system of industrial patronage. The rates were not set neutrally. They were set through a legislative process in which American manufacturers lobbied Congress for protection from foreign competition. Steel producers wanted high duties on imported steel. Textile manufacturers wanted high duties on imported cloth. Sugar refiners wanted protection from foreign cane. Woolen mills, iron foundries, glass producers, and dozens of other industries each sent their representatives to Washington to argue for the rates that would shelter their operations from cheaper foreign goods. What resulted was a schedule of rates that bore the fingerprints of every major industrial interest that had the resources to place a voice in the relevant committee rooms. The tariff did not simply fund the government, it structured the American economy, determining which industries would be sheltered from global competition and which would be exposed to it. The political economy of the tariff was, by the 1890s, a subject of intense and sustained public debate. The populist movement, which had drawn millions of votes behind candidates demanding monetary reform and the taxation of incomes and inheritances, had identified the tariff as a mechanism of class extraction. The argument was precise. American workers paid higher prices for every protected good they purchased, and those higher prices flowed as profit to the manufacturers and the banks that financed them, while the federal surplus accumulated in the Treasury without returning to the working population in any material form. The tariff in this reading was not a revenue mechanism, it was a transfer, from consumers to industrial capital, laundered through the customs house and presented as national policy. The political force behind the 16th Amendment was not, at its origins, the banking networks of New York. It was the agricultural and labor constituencies who had been paying the consumption tax for decades and who understood, with considerable accuracy, who was collecting on it. The men who understood this best were not in Congress. They were in the banking houses that financed the industries that the tariff protected. The connection between tariff rates and industrial profitability was not abstract. A steel company whose imported competition was priced out of the market by a 30% duty was worth more to its creditors and shareholders than the same company operating in a free market. The banks that held the bonds of those steel companies, that provided their working capital, that underwrote their share issuances, had a direct financial interest in the maintenance of high tariff protection. A reduction in the duty on imported steel was not merely a legislative event. It was a depreciation of the collateral underlying billions of dollars in loans. The tariff was not just a tax. It was a valuation mechanism for the industrial capital that the major banking houses held on their books. By the 1880s, the dominant names in American finance were well established. Jay Cooke's firm had collapsed in the Panic of 1873, but the institutional relationships it had pioneered in financing the Civil War debt remained operative in the firms and partnerships that had grown up around it. J.P. Morgan had by then established himself as the central figure in American railroad finance, the man who restructured the balance sheets of failing railways and, in doing so, consolidated the ownership of transportation infrastructure into a smaller number of hands. The Morgan Bank did not merely lend money. It reorganized industries, placed its own representatives on corporate boards, and built networks of financial control that extended across steel, railroad, insurance, and eventually banking itself. John D. Rockefeller's Standard Oil had demonstrated that industrial monopoly, organized through holding company structures and trust agreements, could extract returns that no competitive market would have permitted. August Belmont, the American representative of the Rothschild banking house, remained active in government bond transactions and Democratic Party finance through the 1890s. Kuhn Loeb and Company, the firm that had financed the Union Pacific and several other major railway restructurings, occupied a position in the second tier of New York finance that would prove significant in the years ahead. The House of Morgan was, by the turn of the century, the closest approximation to a central financial authority the United States possessed, and the United States, at that moment, had no central bank. The National Banking Acts of 1863 and 1864 had created a system of nationally chartered banks, but the system had no lender of last resort, no mechanism for adjusting the money supply to economic conditions, and no coordinating institution capable of preventing or containing a financial panic. The supply of currency was tied to the volume of federal government bonds that banks held as reserves, a mechanism that made the money supply dependent on the government's borrowing needs rather than on the credit needs of the economy. When the economy expanded and demand for credit increased, the supply of currency could not expand with it unless the government also increased its debt. When the economy contracted and credit dried up, there was no institutional mechanism for injecting liquidity. The financial panics of 1873, 1893, and 1907 had each demonstrated the same structural vulnerability. When credit contracted and depositors lost confidence, there was no institution capable of injecting liquidity into the system. Banks called in loans. Businesses that could not renew their credit lines failed. Workers lost their wages. Depositors who arrived at bank windows to withdraw their funds sometimes found the doors locked. The panics were not random events. They were the predictable output of a financial architecture that had no stabilizing mechanism at its center, and each one extracted an economic cost that fell most heavily on those who had no reserves of their own to draw on. The Panic of 1907 was the one that forced the issue. It began with a failed attempt by a group of speculators to corner the copper market, spread to the trust companies that had financed the speculation, and threatened to pull down the entire New York banking system. J.P. Morgan, then 70 years old, personally convened the leading bankers of the city in his library on Madison Avenue and, over the course of several nights, organized the rescue. He determined which institutions were solvent and worth saving, which were not, and deployed pools of private capital to prevent the collapse of those he had selected. He pressured the heads of the major trust companies to contribute to a rescue fund. He brokered a controversial transaction in which U.S. Steel, the Morgan-controlled corporation, was permitted to absorb the Tennessee Coal, Iron, and Railroad Company without triggering antitrust action, a deal that required direct intervention with President Theodore Roosevelt, who agreed not to oppose the merger. The federal government played almost no coordinating role. The Treasury Secretary at the time, George B. Cortelyou, deposited government funds in New York banks at Morgan's direction, but the decision architecture was Morgan's. The rescue of the American financial system was, in practical terms, a private operation managed by one man and the network of institutional relationships he had spent 40 years constructing. That man was 70 years old. The arrangement could not continue. The Panic of 1907 produced two institutional responses that would converge 6 years later in 1913. The first was the Aldrich-Vreeland Act of 1908, which provided a temporary emergency currency mechanism and, more importantly, established the National Monetary Commission. The commission was charged with studying the banking systems of Europe and recommending structural reforms for the United States. It traveled to London, Paris, Berlin, and the major financial centers of the continent to examine how the Bank of England, the Reichsbank, and the Banque de France operated. The commission produced voluminous reports. Its chairman was Senator Nelson Aldrich of Rhode Island, the most powerful figure in the Senate Finance Committee, the architect of the tariff schedule that bore his name, and a man whose personal financial connections to the Morgan and Rockefeller networks were a matter of public record. His daughter had married John D. Rockefeller Jr. in 1901. The family connection was not incidental to the institutional relationships that shaped the Commission's work. The second response was a meeting that did not appear in any official record for years afterward. In November of 1910, Senator Aldrich traveled by private railcar from New Jersey to Jekyll Island, a resort off the coast of Georgia, owned by a club whose members included J.P. Morgan, William Rockefeller, and several other figures whose names ran through the balance sheets of American industrial finance. The party that assembled there included Frank Vanderlip, president of National City Bank, which was the primary commercial banking vehicle of the Rockefeller interest and one of the largest banks in the country. Abraham Piatt Andrew, Assistant Secretary of the Treasury and a trusted Aldrich associate, traveled with the group. Henry Davison, a senior Morgan partner who had been instrumental in organizing the 1907 rescue, was present. Paul Warburg, a partner at Kuhn, Loeb and Company, and a German immigrant who had made himself the most sophisticated student of European central banking in the United States, attended and would prove to be the group's primary technical architect. Benjamin Strong, then a Morgan Trust Company executive who would later become the first governor of the Federal Reserve Bank of New York, completed the group. They traveled under assumed names. Vanderlip later wrote that Aldrich had instructed the participants not to use each other's surnames during the journey, and that even the servants at the resort were kept ignorant of the identities of the guests. The meeting was not disclosed publicly until Vanderlip described it in an article for the Saturday Evening Post in 1935, 25 years after it occurred. By then, the institution it produced had been operating for more than 2 decades and had already managed the monetary conditions of a world war. If you're hooked on this story, make sure to subscribe and turn on notifications so you never miss an upload. Your support means everything and helps me bring you more emotional stories like this one. What the Jekyll Island meeting produced was the draft of what became known as the Aldrich Plan, a proposal for a central banking institution organized as a bankers' reserve association with branches distributed across the country, but ultimate policy control concentrated in a board that the major banking houses would effectively dominate. The plan was considered too transparent about the concentration of private banking power it would create, and the progressive political climate of the era made explicit banker control of monetary policy a difficult proposition to move through Congress. What passed instead, after 2 additional years of legislative negotiation, was the Federal Reserve Act signed by President Woodrow Wilson in December of 1913. The bill drew heavily on the Aldrich framework while distributing the appearance of public oversight more broadly. The Federal Reserve would have 12 regional banks. A Federal Reserve Board in Washington would provide a degree of government supervision, but the New York Fed, whose district encompassed the major money center banks, would in practice exercise primary influence over the monetary policy decisions that mattered most. Benjamin Strong, the man who had been at Jekyll Island, became its first governor and held that position until his death in 1928. Paul Warburg served on the first Federal Reserve Board. The institutional continuity between the private meeting of 1910 and the operating institution of 1913 was not coincidental. It was the point. The income tax that arrived in 1913 was not, in legal terms, the first time the United States had taxed incomes. The federal government had imposed an income tax to finance the Civil War, enacted in 1861 and expanded in 1862. The Civil War income tax had reached rates as high as 10% on incomes above $10,000 and had remained in force through 1872, when Congress allowed it to lapse. The tax had functioned, had produced revenue, and had not destroyed the Republic. Its disappearance after the war was not a finding that income taxation was unconstitutional. It was a political decision by a Congress that had returned to the custody of industrial and commercial interests that preferred the tariff. A second income tax, enacted as part of the Wilson-Gorman Tariff Act of 1894, had been struck down by the Supreme Court the following year in Pollock v. Farmers Loan and Trust Company, on the grounds that a tax on income from property constituted a direct tax and required apportionment among the states by population. The Pollock decision was immediately controversial. 4 of the 9 justices dissented. The majority opinion was widely understood as a product of a court whose membership reflected the property interests of the Gilded Age, rather than a neutral reading of constitutional text. The 16th Amendment was, in part, a direct response to Pollock, a constitutional correction to a judicial decision that the progressive majority of the early 20th century regarded as having elevated property over democratic fiscal authority. The income tax arrived in the same calendar year. The 16th Amendment, ratified in February of 1913 after a campaign that had run through multiple Congresses and a Supreme Court reversal of an earlier income tax statute, gave Congress the explicit power to tax incomes without apportionment among the states. The Revenue Act of 1913 implemented the tax, with rates beginning at 1% on incomes above $3,000, roughly $60,000 in present-day purchasing power, and rising to 7% on incomes above $500,000. At those thresholds, the tax initially touched only a small fraction of the population. The vast majority of American workers earned below the exemption level. The structure was not designed as a mass revenue instrument. It was designed as a revenue base that could be adjusted if the government's fiscal needs changed. That provision would matter within 4 years. The simultaneity of these two events, the Federal Reserve Act and the income tax, was not coincidental, though the causal relationship between them is rarely examined directly. The logic runs as follows. A central bank that can manage the money supply and act as a lender of last resort requires, in extremis, a government capable of backing it. A government capable of backing a central bank requires a revenue base that is not dependent on the tariff cycle. The tariff fluctuated with trade volumes. In a financial crisis, trade contracted, customs revenue fell, and the government's fiscal position weakened precisely when it needed to be strong. An income tax, drawing on the aggregate income of the economy rather than on the volume of international commerce, provided a more stable and, critically, an expandable revenue base that moved with economic activity rather than against it. This is the mechanism that the Standard Account of 1913 consistently fails to make visible. The income tax and the Federal Reserve were not parallel reforms that happened to coincide. They were complementary institutional changes that together transformed the relationship between the American state and the financial system. The tariff had funded a government that could not backstop a central bank. The income tax funded a government that could. The Federal Reserve created the central bank. The income tax made it viable. The interest that had organized the Jekyll Island meeting understood this architecture. Paul Warburg, whose public writings on central banking had been circulating in banking journals since 1907, was explicit in his correspondence about the connection between fiscal stability and monetary credibility. A central bank whose government lacked a reliable revenue stream was a central bank that could not be trusted to honor its obligations in a crisis. The Europeans had understood this for centuries. The Bank of England operated within a fiscal framework backed by British parliamentary tax authority going back to the late 17th century. The Reichsbank operated within the German imperial fiscal system. American monetary reform required American fiscal reform, and the men who designed the former had every reason to track the latter. The records of the National Monetary Commission show that the Commission's staff economists analyzed the revenue structures of European governments in detail, including the income and inheritance taxes that several of those governments had already implemented. The connection was not incidental to the reform program. What the record also shows, when placed beside the official account, is who paid under the old system and who would pay under the new one. The tariff was a consumption tax. It fell on everyone who purchased imported goods, which in a practical sense meant it fell most heavily on those who spent the largest proportion of their income on goods, which was not the wealthy. A man who earned $50,000 a year in 1900 and spent $5,000 on consumption paid the same tariff dollars as a man who earned $1,000 and spent all of it. As a share of income, the tariff burden fell inversely with wealth. The system that had funded the American state for most of its history extracted proportionally more from those with less. The income tax, at least in its initial design, reversed this directional relationship. It exempted the working population entirely and taxed only those with incomes above the $3,000 threshold. The progressivity was modest. The rates rose slowly and the top bracket applied only to the largest incomes. But the directional change was real, and it was understood as real by the political forces on both sides of the debate. The progressive movement that had pushed for the income tax for 2 decades framed it explicitly as a correction to the regressive character of the tariff. The industrial interests that had depended on tariff protection framed it as an assault on accumulated capital. Both characterizations contained elements of the ledger that the other side preferred not to acknowledge. The question of whether the income tax represented a genuine redistribution of fiscal burden or a tactical concession designed to forestall more radical reform is one that the political record of the era does not resolve cleanly. Andrew Carnegie, who had built his fortune behind the tariff wall on imported steel and had sold his steel company to J.P. Morgan in the largest private transaction in American history up to that point, had publicly advocated for progressive inheritance and income taxes since the 1880s. Carnegie's argument was strategic as much as moral. The concentration of wealth in the hands of a small industrial aristocracy was, in his view, a political and social risk that threatened the stability of the capitalist order. Moderate redistribution through taxation was preferable to the alternative of class conflict that he saw developing in the labor movements of Europe. The income tax, in Carnegie's framing, was not an assault on capital, it was capital's insurance policy against something worse. Whether that calculation was sincere or self-serving, it was shared by enough figures in the financial establishment to remove the most credible opposition from the legislative path. The Socialist Party had been gaining votes. The labor movement was expanding. The progressive wing of both major parties was demanding structural changes to American capitalism that went well beyond a modest income levy. The men who had organized at Jekyll Island were sophisticated enough to understand that the political price of defending the old tariff-funded, panic-prone, Morgan-managed financial system was rising faster than the system could absorb. A modest income tax and a Federal Reserve with visible public oversight was a better outcome for institutional capital than the alternatives that were being discussed on the left wing of American politics. The concession, if it was a concession, was calculated. What the archival record shows most clearly is the sequencing. The National Monetary Commission's work ran from 1908 to 1912. The Jekyll Island meeting occurred in 1910. The Aldrich Plan was published in 1911. The 16th Amendment was proposed to the states in 1909 and ratified in 1913. The Federal Reserve Act passed in December of 1913. The Revenue Act implementing the income tax passed in October of the same year. These were not independent legislative events that happened to arrive together. They were the products of an overlapping reform process in which the fiscal and monetary components were understood by the key participants to be interdependent. The gap in the record that matters most for this argument is not in the legislative history of the 16th Amendment, which is extensively documented. It is in the private correspondence between the banking houses and the Treasury officials who managed the transition from tariff dependence to the income tax and Federal Reserve architecture. The papers of Nelson Aldrich held at the Library of Congress are extensive, but several categories of correspondence from the 1910 to 1913 period have been noted as incomplete or absent from the collection. The private communications between Morgan partners and Treasury officials during the 1913 legislative sessions are, in the surviving record, largely administrative rather than strategic. The working-level discussions in which the institutional design was refined are not fully preserved. That absence is itself a data point. Institutional decisions of this magnitude do not get made without extensive private communication. The documentation that would show exactly how the bargain was struck is not in the public archive. What the record does show, in the years following 1913, is what the new architecture produced. The Federal Reserve's early operation was shaped heavily by the New York Fed under Benjamin Strong, who maintained close relationships with the Bank of England and, through the 1920s, coordinated interest rate policy across the Atlantic in ways that prioritized the stability of the international gold standard over the conditions of the American domestic economy. The income tax, meanwhile, expanded in ways that the initial rates had not suggested. The rates that had begun at 1% and 7% were pushed sharply higher to finance American entry into the First World War. By 1918, the top marginal rate stood at 77% on incomes above $1 million. The revenue base that had seemed a modest supplement to the tariff in 1913 had, within 5 years, become the primary fiscal engine of American state finance. The tariff, which had funded the government for a century, was now a secondary instrument. This transformation was not simply a product of wartime necessity. It reflected the new fiscal architecture's design. An income tax is politically flexible in ways that a tariff is not. A tariff rate can only be changed by reopening the legislative bargaining process that sets it, which involves every industrial interest whose protection depends on the existing schedule. An income tax rate can be adjusted by a single piece of legislation, applied to a base that grows automatically with the economy, without disturbing the underlying structure of industrial protection. The income tax gave the government a fiscal tool of an entirely different character, one that could be expanded rapidly in an emergency, contracted afterward to reduce political pressure, and expanded again as circumstances required. That flexibility, combined with the Federal Reserve's ability to manage monetary conditions between fiscal adjustments, created a state financial architecture of unprecedented adaptability. The men who built this architecture in 1913 are not obscure figures whose role requires excavation from sealed archives. Nelson Aldrich's name is on the commission that produced the blueprint. Paul Warburg served on the first Federal Reserve Board, appointed by the same President Wilson who signed the Federal Reserve Act. Benjamin Strong governed the New York Fed for 14 years and was, during that period, the most powerful monetary authority in the world. Frank Vanderlip ran National City Bank, the institution that became Citibank and eventually Citigroup. The institutional descendants of the banks they represented still appear in every major transaction in American and global finance. The Federal Reserve is one of the most studied institutions in American economic history, and its founding documents are publicly available. The Jekyll Island meeting has been described in multiple memoirs, official Federal Reserve histories, and academic studies. None of this is buried. What is less often assembled is the complete picture that the ledger presents when the fiscal and monetary histories are placed beside each other, rather than told in separate accounts. A government funded for most of a century by a consumption tax that sheltered industrial capital from foreign competition. A succession of financial panics that demonstrated the impossibility of sustaining a modern economy without a central monetary authority and a lender of last resort. A private meeting on a Georgia island at which the men who controlled the dominant institutions of American finance drafted the institutional solution. A pair of legislative acts in 1913 that replaced the old fiscal architecture with a new one in which the government could tax income, the central bank could manage credit, and the two institutions could support each other in ways the tariff system had never permitted. The income tax of 1913 was not the moment America became a taxed nation. Americans had paid customs duties for over a century, and those duties had funded a government that fought a civil war, built a transcontinental railroad system, and absorbed the largest peacetime immigration in the country's history. The income tax was the moment the tax fell on income rather than consumption, on the accumulation of wealth rather than the purchase of goods, and on a base that would expand with the economy rather than fluctuate with the tides of international trade. Whether that change represented democratic reform or the completion of a financial architecture designed to serve institutional interests is a question the ledger does not resolve with a single answer. It shows both things at once, the genuine progressive demand for fiscal equity and the institutional calculation that modest fiscal reform was preferable to the alternatives that were accumulating political force in the years before 1913. The architecture that was completed in that year is still operational. The Federal Reserve still sets monetary policy for the largest economy in the world. The income tax still funds the federal government, at rates and on a base that have expanded enormously beyond what the Revenue Act of 1913 contemplated. The institutional descendants of National City Bank, of Kuhn, Loeb, of the Morgan Partnerships, still hold dominant positions in American finance under the names that consolidation and rebranding have given them over the past century. The building on Jekyll Island where the meeting occurred in 1910 has been preserved as a historic site. The names on the plaque identifying the participants are the same names that appear in the charter documents of the institutions that shaped the American century. The ledger shows all of this. What the standard account leaves out is the question of sequence. Who designed the architecture, who benefited from the transition, and what the institutional relationships were between the men who drafted the Federal Reserve Act and the men who simultaneously supported the ratification of the 16th Amendment. When those threads are placed beside each other, the two great financial reforms of 1913 are not independent progressive victories. They are two halves of a single institutional design, built by overlapping networks of financial and political power, that replaced one system for funding the American state with another that was better suited to the demands of a central bank, a global war, and the century of American financial dominance that followed. Thank you so much for watching until the end. If you love this story, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next story.